Hey everyone, welcome back to the Nadlan Forum Podcast Daily. I am Lior, and yeah, if you've been watching mortgage rates this week, well, I hope you had your seatbelt on. This was one of those wild rides that, honestly, I haven't seen in a while. So let's just break it down a bit. Early in the week, rates seemed somewhat stable, but man, did things heat up by Wednesday. There were some pretty robust reports on jobs and the services sector, stronger than most people expected. And that really made the bond market jump. Now, when bond yields rise quickly, mortgage rates almost always follow. And that's exactly what happened. 30-year fixed average got pushed practically overnight up to something close to 6.4%. That's one of the highest levels we've seen in the last month or two, which is a bit sobering if you're shopping for real estate right now. I mean, we've talked about these jumps in past episodes, but this week really hammered home just how sensitive these rates are to every blip in the economy. I'll share a quick story. So, I was on the phone with a client in New York, and we'd been waiting together for a sign that rates would dip so he could pull the trigger on a refinance. He started second guessing. Do we wait one more day, or is this as low as we're going to get? It's tough, because this back and forth. We saw rates inch up midweek, then drop a little, then you blink, and it's moving again. If you try to time it perfectly, I promise, you'll drive yourself nuts. But keeping a close watch and having your documents ready, that makes all the difference in this type of market. Anyway, fast forward to late in the week. By Thursday and Friday, things calmed a bit. There was some weaker economic data in the mix, and it helped bonds recover, pulling rates down from those crazy highs. So we didn't end the week at the worst levels, but it's been up and down for sure. This week is a great example of how even when the headlines say stable, you gotta look under the hood to see what's really going on. Let's shift gears a little. We talk about bond yields a lot because if you follow mortgage rates, you pretty much have to follow what's happening in the bond market. Really, rates track almost tick for tick with what's going on in treasury yields, especially the 10-year. This week, it played out so clearly. The moment bonds weakened after those jobs and services reports, mortgage rates jumped right up. But then Friday came along. We got some fresh data from the University of Michigan, their Consumer Sentiment Index. And honestly, it wasn't great. Confidence took a bigger dip than most folks expected, which means, people are cautious about spending because of inflation and I'd say just overall uncertainty. Now here's how do I explain this? So when the sentiment data hit, bonds actually got a bit stronger, which set the stage for rates to maybe tick down. And this is where it gets tricky, the move came kind of late in the session. Most lenders, by that point, they're not updating their rate sheets midday for a move like that. What you see in the morning usually sticks around, even if the market shifts by the afternoon. I actually saw this real world with a borrower I was working with. We were just about ready to lock, right? And suddenly I'm watching rates get a bit better as the day rolls on. But because the bond rally came too late, it wasn't reflected in the mortgage pricing until after hours. My client, poor guy, was banging his head saying, why didn't we get that lower rate? Timing, it's everything. If you're a borrower or helping someone finance, it's really important to understand that what happens in the market doesn't always show up right away in what lenders offer. And this isn't new. Going back to other episodes, like the one where we talked about the Fed being cautious because of missing or late data, it's the same theme. Little surprises, late moves, they impact rates, but not always in real time for borrowers. So, big question. Where do we go from here? Well, we're staring down another week where pretty much anything could happen. Key data releases are on deck, especially inflation numbers and labor stats. And these are the same things making or breaking rate movements every single week. The December Fed meeting is looming, so everyone in the markets got radar up for any signal that the Fed might shift policy one way or the other depending on new numbers. A lot of experts are saying, and I'd agree, that we're in this phase where, honestly, even a small surprise in the data, a slightly hotter inflation print, or a jobs number that's off by just a bit, could push mortgage rates noticeably higher or lower in a hurry. If there's one thing I've learned, is that expecting normal in this environment is just asking for trouble. It's maybe a terrible analogy, but it kind of reminds me of surfing. You can't predict the perfect wave, but you can be ready with your board when the right one comes. But I might be stretching here. Let me wrap with a quick example. I actually had an Israeli client last year trying to navigate a pre-approval right when rates were all over the place. I remember her calling me late at night. Time zones, right? So she could lock in before a report came out the next morning. She understood that a single data point could make a 0.5% difference within hours. That level of attention paid off. She got the rate she wanted and didn't have to deal with higher costs later. So if you're eyeing a mortgage or refi right now, be ready, stay in touch with your lender, and don't be shy about asking about day-to-day changes. All right, that's all for today's episode. The mortgage market's definitely not boring right now, but that also means there's opportunity out there if you know where and when to look. We'll be back soon to break down whatever twists the next week brings. So until then, stay smart, stay prepared, and as always, reach out with your questions. Talk to you next time.